a video podcast to help you grow your financial knowledge and build a life you deserve. We are back with part 2 of how to invest for retirement. Today, we're going to be chatting all about personal tax advantage retirement accounts, or IRAs, which is your individual retirement accounts. We'll also talk about what your options are when we're looking at IRAs, as well as how you can take advantage of this to build a financially stable retirement in the future. But before we dive in, I am Kevin, and I am one of your co-hosts of Neighborhood Money. And again, across the screen is Drew Norrie.
How's it going, neighbors?
Really excited to be back in the quote-unquote studio and really looking forward to this discussion today. But before we get into that conversation, I really wanted to say thanks for listening. And there's really 3 ways that you can help support this podcast if you have been finding that is bringing value to your life. The first is, if you are listening to the podcast through the audio version, please go out and rate the podcast and review it. Those reviews really go a long way to helping us grow this podcast. If you are listening and watching on YouTube, subscribe to our channel as well as like this video. And if you want, leave us a comment and a question, and we'll definitely get back to you and potentially give us some good ideas for future episodes. And then the last thing is, you can follow us on our social media accounts. So you can find us on Instagram, Facebook, and Twitter, where we post daily, and if not, multiple times a day.
And also, if you're in any of those social medias, honestly, just comment down below and just let us know what you want to hear from us. We want to try to give you guys content you want to hear. And if you guys, can write something down there, it's going to help us be able to bring you guys more value as well.
So Drew, let's get going. Let's dive into individual retirement accounts. So last week, it talked a lot about employer-sponsored retirement accounts. And so this is kind of the flip side. So this is going to be you personally setting up a retirement account. And there's different rules around IRAs versus your employer sponsor, but there's a lot of similarities as well.
Yeah, I think just one thing just to say right off the bat here is, if you listen to last week's episode of the part 1, is you're going to hear a lot of the same terms between contributions, the retirement stuff, and other certain types of limits and pre-tax and post-tax. But I think one thing we just want to let you guys know is, in the part 1, it was all employer sponsored. So it's your employer just setting up these accounts for you. And today it's more of your personal account. So you're going to have to go out and actually sign up for these accounts yourself and manage them yourself as well.
So where you can really go out to find and set up some of these accounts, they're really offered from banks, brokerages, federally insured credit unions, and some other companies and associations. But Drew and I really wanted to mention a few companies that were out there that we're aware of that are highly recommended, and then also some of the companies that we use. So if you're looking at trying to figure out, okay, well, what type of company should I go with? Here are some of your options. Vanguard is a very well respected company in the industry, as well as Charles Schwab and Fidelity. And I know, Drew, you use TD Ameritrade.
Yep, I use TD Ameritrade. I do most of my trading through them. And I also decided to open a Roth IRA through TD Ameritrade, and it went over pretty smooth. So the company I was working with before, I had a 401k from the employer. And all I had to do was reach out to that plan provider and just say, hey, I want to transfer and roll over my 401k Roth into my Roth individual retirement account. And it was just a few emails, a little bit of paperwork, and then just signing up through TD Ameritrade, and money is in there, and I can trade different types of securities such as stocks.
And a lot of these companies have really excellent customer support. So even if you're not rolling over an employer-sponsored plan, it's really easy to get these set up. We personally, in my family, we use M1 Finance. When we first set it up, I think it took a whole maybe 10 or 15 minutes from start to funding the account and actually making an investment through M1 Finance. The companies are pretty typically going to walk you step by step on exactly what you need to do.
They'll be able to walk you step by step through the internet, but don't be afraid to call them. I know, at least with TD Ameritrade, the customer support number was just about on every page. I actually reached out to them. There's a couple of spots where I just wasn't exactly sure, so I called up customer support. I probably didn't have to wait 3 minutes to get on speaking with them, and they walked me through and just clarified a few terms and just kept moving forward after that.
So what exactly is an individual retirement account? So at its really most basic level, it's like we said, it's an account that you are going to invest in for retirement outside of your employer. And the first IRA, or individual retirement account, is going to be your traditional IRA.
And with this traditional IRA and, with it saying individual retirement account, one thing that's different between this and your other just trading stocks is, remember, this is also a tax advantaged plan. With this traditional IRA, the individual retirement account, the one thing you just want to remember is that it's going to be tax deferred. So the taxes aren't really coming out now, but then later in the future when you withdraw, the taxes will be coming out.
So Drew, what's a good example for our listener here?
I would probably say if, for example, you had, let's say your paycheck was $1,000 and let's say your taxable rate was 20%. So from your $1,000 paycheck, taking the 20% tax rate, you're going to have to pay $200 of tax.
Yep.
And now for this example B, this would be if you're using your tax advantaged traditional individual retirement account. Let's take that same $1,000. And what we want to do is, since it's pre-tax or tax deferred, we want to make a contribution before the tax comes out. So let's say $100 you want to contribute towards your traditional IRA. So now you have your $1,000 paycheck minus your $100 contribution. You have your $900. Now that $900 is what's getting taxed at your 20%. So now you're paying $180 in. So you're going to see between example A with $200 you have to pay tax, example B with $180 tax, there's a $20 difference. And this is an extra $20 that's going to be growing tax deferred, which means more money in your account now, but then taxes will be taken out when you withdraw.
So when you think about your traditional account, at the end of the day, what it does is it lowers your taxable income by the amount you contribute to the account. And then that money will grow tax deferred. And by tax deferred means that you will be taxed on that money once you start withdrawing from this account in retirement.
Correct.
And so one big rule for individual retirement accounts is that you can only contribute earned income that you make. And there's some rules around what is earned income, but you can only contribute up to 100% of your earned income, up to some limits. And so those limits really are $6,000 per year if you're under 50. And then if you are 50 years or older, you also get a $1,000 additional catch-up contribution for a total of $7,000 per year.
And when we're talking about these limits, once again, we want to let you guys know that these are your personal accounts. Before last week, you may be saying, hey, I thought that limit was way higher.
Yep.
I believe it was, what we had, the 19,500 for 2021.
Yep.
And now you're looking at 6,000. You're saying, hey, that seems way different. And just remember, this is a separate account. This is one that you're doing on your own. And you can actually have your employer sponsored and your individual together.
Yeah, that's a really good point. You can definitely have both. There are some rules when you dive into it, but for the most part, you can have both, and you should leverage both so that you can build both inside of your employer, but then outside in your personal retirement account.
Yeah. And I think one other thing just to add on top of this is if you're working for a company and they don't have any investment or retirement programs, this is a way for you to still put money away with tax advantages, and you don't have to worry about your company being the one that makes or break your retirement. This can be on your personal benefit as well.
Sometimes your employer sponsored plans, you might not like the assets that exist within it.
Sure.
Now, typically, an individual retirement account will have more options available to you. So it might even be beneficial for you to look into this because you might have more options to invest in if you aren't particularly pleased with what your employer offers.
Yeah.
And some of the rules are very similar to your employer-sponsored plans. So if we think about when you can have access to your traditional individual retirement account or traditional IRA, funds, you have to be 59 and a half or older to get this money. And that at that point in time, when you start withdrawing this money from the account, that's when you're going to start paying income tax on any contributions you made, but also any gains that you've made over the course of your investing time.
Yeah. And remember, it's just 59 and a half. They have that number. So if you withdraw before that, there are penalties. On top of the penalty, the 10% penalty, you'll also have to be paying your ordinary income taxes. There are a few exceptions here or there, but they're really not in your day-to-day occurrences.
You definitely just don't want to touch this money until you get to those retirement years, because that at the end of the day is what it's ultimately ultimately made for, and that's ultimately what it should be used for. Similar to your employer-sponsored plans, you do have to start taking money out at a certain age through your required minimum distributions, and that's going to be at age 72. Again, like we said last week, we won't get into the details there because it's really dependent on your individual situation on how much you have to withdraw from your account. But just be aware, just like your employer-sponsored plans, you do have to start taking out this money at 72 years of age. And so, if we look at the assets side, or what are your investment options, like I just mentioned a couple of minutes ago, you really have a lot more opportunities here. So similar to your employer-sponsored plans, you'll have mutual funds, bonds, ETFs. But even in addition to that, you can invest in individual stocks within your traditional IRA. And there's different types of real estate funds and things like that, which really just allows you to diversify more if you want to.
Yeah. Allows you to diversify, allows you to be flexible in what you wanting to do. If you want to be very aggressive and active, you can be on it daily if you really want to be. And you can also have it as a set it and forget it, and you can find certain accounts that you just put money in there, and like say like a mutual fund, and they will have certain accounts and investments inside those that will help grow your account.
Yeah, and I think now is a really good time just to reiterate a point we made last week, in that your individual retirement account is really that vehicle where you're going to invest inside of. The vehicle, your individual retirement account, is going to allow you to take those tax advantages, and then you're going to have to pick those assets inside to invest within. So even when you go and set up an IRA, you still have to choose the assets that you want to purchase within it.
That's a very good point. So you just have to think about it as you're signing up for the option to be able to have certain investments inside of another vehicle.
Right. Similar to last week, we talked about traditional, and then we also talked about Roth. It's the same thing for individual retirement accounts. There are Roth IRAs, and it's essentially the same thing in that when you put money into a Roth IRA, you are putting in after-tax income into this account that will then be able to grow tax-free.
If you remember in the previous example, if you didn't contribute anything with example A, you have your $1,000 paycheck at your 20% tax rate, you're end up paying $200 of tax. And example B was a tax-deferred plan, pre-tax, so you had your $1,000 minus your $100 contribution, and now you have $900 that's being taxed at 20%. So then you have $180. So now with this Roth, so example C will have that same $1,000 paycheck, but this is a post-taxed plan. So it's going to be your $1,000, and now since it's post-tax, we have to tax that $1,000. So the 20%, so we have $200 you're paying in tax, but now you want to contribute money towards your IRA. So you grab $100 and you can put it in there, and this money will grow tax-free. So when you take the money out, you're not paying taxes on it. But the thing that may be kind of confusing with that one is you're still paying that $200 taxes, and maybe you're contributing this $100. And I guess the way you'd end up looking at it is you may have less money in your pocket now after the taxes, but in the future, you won't be paying any taxes on that money.
And that's the big benefit of a Roth IRA, is that once you put the money into the account and you invest it, any gains that you see or any contributions, there is not going to be any more taxes taken out. So whatever your account is at retirement, and that's going to be what you're going to start pulling from, and not even have to worry about taxes in the future. Very similar to the traditional side. In order to invest into a Roth IRA, you have to have earned income, and you can only invest up to a certain contribution limit. Actually, it's the same as a traditional IRA. So it's $6,000 if you're under 50, and you have that additional $1,000 of catch-up contributions if you are 50 years or older, totaling a total of $7,000 per year.
And on top of these limitations, something I do want to add is if you end up leaving a company and you had your employer-sponsored 401k and you wanted to roll it over into this Roth IRA and say, hey, my dollar amount in my employee fund is more than $6,000. How can I roll this over? That's one of the exceptions. You can roll over that total amount and you won't have any penalties.
There is some rules around income limitations. We won't dive into details here, but just be aware that whether you're single or married, depending on how much you make, you may or may not be able to contribute the full $6,000 or $7,000 $1,000, you might only be able to contribute part of that amount of money or none at all. It's really depending on how much you make per year.
Yeah. And these numbers tend to be changing almost once a year.
Right.
That's another reason we don't want to get too into the details on it.
Essentially, these limitations are set by the IRS, and they raise them every year, or mostly every year, really to keep up with inflation.
Yeah.
In order to access your Roth IRA money, similar rules again apply as to the traditional IRA. So you have to be 59 and a half or older. Just to reiterate, this will be tax-free because you put in post-tax contributions into the account. There is one interesting rule that applies to a Roth IRA, and that is the 5-year rule. And what the 5-year rule is, you have to have your Roth IRA open for 5 years in order to access any earnings without penalty. So in addition to being 59 and a half years old, you also have to put a contribution into your account and wait 5 years before you can access any of those earnings.
That's a really good one to, understand. It's one that you probably don't hear too often, but it is a nice one to reiterate.
Another really interesting aspect of a Roth IRA is that you can actually access your contributions that you put into the account at any time without penalty. And because you've already paid taxes on it, you don't have to pay taxes on withdrawing any contributions.
Yeah.
Just one note is that when you do pull out, or if you do pull out contributions, you no longer have that invested. So you're no longer going to gain any capital gains or interest on that money.
Correct.
So if you access any of the earnings that you've gained on your contributions before 59 and a half years old, this is where you're going to have to pay your income tax plus the 10% penalty.
And just like the traditional IRA, there are certain types of exceptions without getting that penalty when you're withdrawing your earnings before 59 and a half. One of these exceptions would be medical bill that is way out of the ordinary. You could potentially have, a debt, like if you were to die and pass it on to your beneficiary. But like I said, with traditional, these things aren't really in your day-to-day occurrences.
Right.
So it's a good practice just to keep your money in there, set it and forget it, because if you take the money out, you're not making money on that money anymore.
Exactly. And I think, it's really a good point to call out that if you do die with these, both the traditional and the Roth, you can pass it on to your beneficiary without those penalties. It is definitely a good feature of an individual retirement account. But a very interesting, in my opinion, a big benefit to a Roth IRA is that they don't actually have any required minimum distributions.
Yeah. So in the traditional, at your 72, you had certain distributions that you have to take out according to the IRS and their tables. So on the contrary, we have now the Roth IRA, and you don't have to worry about all those funky numbers. It's just the numbers that you have in there, and you can take it out when you feel like it, and there's no minimums on it.
And you can keep investing into it beyond the 72 because there's no limit. And I think one of the really cool parts is that if you don't end up needing this money, you can pass it off to whomever you decide to put as your beneficiary in your will. And so that's a really good way to, whether if you have kids or not, to really pass off this money to really set up the next generation if you so choose to do so. On the asset and the investment side, it's very similar to the traditional IRAs. Actually, it's probably going to be the exact same thing because it's the same company and they're going to have the same options for you. But again, this will most likely have more investments available to you than your employer-sponsored plans.
Yep.
And then the last two that we wanted to talk about here today, and we'll really talk about them together because they're a little bit different than the traditional and Roth individual retirement accounts. And that's going to be your simple IRA and your SEP IRA.
Yeah, and these two, as far as the individual goes, it's not an IRA many people are going to be touching. And the reason for that is when you're looking at this SEP or the simplified employer pension or your simple IRA, like if you're a business owner, you're self-employed or a sole proprietor. So unless you're really making money with a side hustle on the side or you have your own type of maybe LLC, you're really not looking at these type of IRAs. But if you do have a small business or you are your only employee in your own business, there are benefits to using these IRAs compared to your traditional or Roth.
Definitely. So there's a lot of similarities to the traditional Roth, but some of those benefits of a a simpler SEP is that you're going to have the ability to contribute more to these accounts than you would in the traditional and Roth IRA. So if you remember, we just said that your limit is going to be $6,000 in the traditional and Roth IRA. That's going to be quite different for the simple and the SEP. So if we dive into the SEP specifically, or the simplified employer pension IRA, this is really going to be fully funded by your employer.
If you're an employee working for a company that has a SEP, you're not putting any money towards this IRA. It's all from your employer. And whatever the employer gives himself, he has to give to his employees. So
Right.
I would probably say if you're a small business, you're most likely going to have some type of a 401k compared to this, because it would be more beneficial and give more incentive for your employees to participate with you.
But one really interesting thing of a SEP that is not the same as other employer-sponsored, like a 401k, is that you're actually going to be vested in this money, into the money that you receive right away, day one, when you start with a company and start getting these contributions from your employer.
That's a very good point. So this is saying with being fully vested day one, with all this money that your employer is putting in, that means if you wanted to leave that company, you can take all of that money that was funded into your account day one. With the 401k employer sponsored plans, I think most of the times you see they'll have maybe a 5-year vesting period. So if they're matching what you're putting in and you leave before that 5-year period, you don't get any of that money that the employer's putting in for you.
Right. It's definitely a lot more flexibility to be able to leave the company if you so choose to do so. And you'll be able to take all of that money with you. And then the second one is the simple IRA, and that is really offered through small businesses that have less than 100 employees, but it really operates pretty similar to other employer-sponsored retirement plans like a 401k.
And I would say if there's anything that's kind of a little bit different with these simple IRAs, and I think a lot of people like to say it's more archaic type of rules, is if you're in the simple IRA, you have to be in this simple IRA for at least 2 years, or have it just stay sitting there open for 2 years before you roll it over into another account without getting penalized. Normally, if you're rolling over from an account to an account, it's tax-free. Like, you don't have to worry about paying taxes on it. It's just more or less a title change of your investment vehicle.
Right.
But with this one, you have to stay in that simple IRA for 2 years, and if you try rolling over before there, you get taxed and penalized pretty good on those.
Very similar to other accounts that we talked about, your employer can either offer a 2% match to all employees or up to a 3% match, really depending on the situation that you're in. And then your contribution limits are going to be quite higher than the individual retirement accounts, so your traditional or Roth, where you'll be able to put in $13,500 annually if you're under 50. And if you're 50 years or older, you again will be able to put in catch-up contributions of up to $3,000 per year. So we've really walked through your traditional IRA, your Roth IRA, and then briefly touched on both the simple and the SEP IRAs. So Drew, what do you think the listener here should really take away from this conversation?
Well, I would say going through the part 1 episode last week of employer sponsored and then this week of individual accounts, the thing I want to let people know is you have options out there for investment vehicles for your future and retirement. Not every company is going to be offering some type of a 401k or, some SEP or simple IRA potentially,
right?
Or pensions. 403bs, etc. And if you're in a job saying, well, how could I invest for retirement because my company doesn't have something for me to put money into? I just want to let you guys know that there are options, and these are some of the options of you can still take advantage of these tax advantaged pre-tax, post-tax type of accounts.
And even if your employer does offer a retirement account to you, you can really use both. So you can set up your employer sponsor, and then you can also set up your personal individual retirement account. And you can really use both to set yourself up for stability in your retirement down the line. And I think, just to add to that, personally, I really like the Roth IRA and taking advantage of that tax-free growth over the course of your working years when you're looking to retirement, because at the end of your working career, when you're looking to go into retirement, all of that money is going to be yours and you won't have to pay taxes on it. So it's definitely something good to have in your toolkit, and you can
Yeah.
definitely use it in addition to any of your pre-tax retirement plans.
And all of these are still great options if you prefer the traditional over the Roth or the Roth over traditional. I mean, it's all going to be on your personal opinion, and I think
For sure.
it's just very important just to understand that don't feel bad about which one you get into. I think it's just important that you at least have an interest to potentially look into this.
And get started investing, because
Yep.
time is your biggest friend when you're looking at retirement investing.
Yeah.
And so let's move on to the next segment here, Drew, which has been our favorite segment so far. And that's really what's going on in your neighborhood. So if you're listening for the first time, this segment is where Drew and I each share with you really what's going on in our personal life. And it doesn't necessarily have to be money related. And actually, it hasn't really been money related all that much over the last 3 episodes. And so it's really an opportunity for you, the listener, to know a little bit more about us, as well as for us to share, some of the things that we're seeing and learning in our lives with you. So Drew, what's going on in your neighborhood?
In my neighborhood, well, I just started a kitchen demo, and
Fun.
me being in front of the computer a lot, this computer body isn't quite used to all the physical work, so I've been a little bit sore. I've
There
been a
you
little
go.
sore the last couple days, but it's been really fun to actually go through it and, in a way, reverse engineer the house and kind of see how
Right.
it was built
Yeah.
from, the guts of it.
Mhm.
And so it's a really cool learning experience. And, going through a kitchen remodel, it's maybe not the best financial investment, but
Sure.
there's also this, value investment of we're going to be in this house for a while, and it's going to be an area that, we're going to love, we're going to enjoy, we're going to use on a
Right.
daily basis. And
Yep.
just that investment in our life is kind of what we're, getting out of
Yeah,
that one.
really increasing your quality of life on a day-to-day basis. And I think that's really overlooked when we talk about money and investing, and specifically for retirement. There's things that might not make sense on an investment standpoint, where you might not get even your money's back. But if it's improving your quality of life, like, it's definitely a great option. And like you said, your kitchen remodel is definitely fitting that bill.
Yep. And with that said, this will be I believe my last episode in this room for the video podcasting part of it. So if
Yep.
you're watching on YouTube, this will be the last week I'll be in here for probably 6 to 8 weeks. And
Yeah.
then, so I may be all over. This background may be changing. I don't know
Yep.
what the audio is going to be like in the next couple weeks, but we'll be working through it.
Yeah, and we'll make it through it. Actually, Drew has been sending me some videos and pictures of the kitchen demo, and it's pretty cool to see, the studs and the floor completely wiped out and no cabinets and anything in there, which, Drew, you've done all by yourself, right?
Yep, myself and my pregnant wife has been helping too here and there. I don't want her to lift too much or be around too much dust, but
Yeah.
some of the small stuff she likes to help out with. But yeah, with all that said, what's happening in your neighborhood?
So this last week has been pretty interesting. So each year outside of last year with COVID-19 and the pandemic, my family goes down to Milwaukee to the Irish Festival. It's typically a 4-day long festival. And, we really just enjoy going down there and listening to the bands that we have followed now for several years. But in preparation for the trip now with 2 kids, we basically have lived Murphy's Law. And if you're not familiar with Murphy's Law, it's whatever can go wrong will go wrong. So it started out with our check engine light going off this week and us needing to get it into the shop to get something fixed so that we could drive down to Milwaukee. We also needed an oil change, which, granted, that was on us for not planning in advance. But then the biggest kicker is that we have a dog, Ava, and we need to get her into a kennel. Well, we called, I think it was 4 or 5 different kennels, and finally got one that let us in because there was someone that canceled on them. And so then we had to go through all these different loops around, well, we need to make sure that Ava, our dog, has all the vaccinations, which she did, luckily. But she also had to have a fecal test, which no other kennels, asked for. So today, the day before she's going to the
fecal
kennel.
sample.
Yeah, yep, exactly. Yeah, just wild. But so today, I had to bring that to the vet. And so I was watching Ava outside trying to do her business so that I could get that and get it over to the vet and make sure that she could get in and we could actually go to the Irish Festival. So it's been quite the whirlwind in our life, just trying to get prepared to get down there. But at the end of the day, once we're down there, it's such a great time.
Speaking of Murphy's Law, you're lucky you didn't have it completely, because if you did, Ava probably would have been constipated.
Yeah, you're not lying. But hey, we aren't out of the woods yet. We leave tomorrow, so we'll see if we actually get on the road and get down to Milwaukee for the festival.
Perfect. Well, that's what's going on in your neighborhood. I think going forward, we'd also love to hear what's happening in, everybody else's neighborhood. So that's,
Definitely.
Kind of brings us into, if you're using the comment section in YouTube or Twitter or Instagram, Facebook, or in the review section of our podcasting, I think that would be a great area to just write in there. And then, we'd love to be able to pick one and kind of talk about it on top of our neighborhoods as well. But everything like that said, I think that brings us to the end of our episode. And as we said in the beginning, if you guys could write a review, like, share, comment, follow our socials, that would be awesome. And with all that said, we'll see you next week in the neighborhood.